Oh, hi everybody. Amy, is my sound coming through okay?
Yep.
Perfect, thank you. Oh, let me just kind of fix one thing on my end here. All right, so normally when I talk about taxes, the sun isn't shining. Taxes are suddenly less important and less fun when we're starting to get warmer weather. So I appreciate all of you sharing your time with us tonight, attending. This is one of those really important topics that are just kind of icky, right? Nobody farms because they really love filing taxes. So I just wanted to take a second to just acknowledge and thank everybody for being here tonight. That being said, let me go ahead and get our presentation started.
Yeah. And as Caitlin's doing that, I'm going to introduce you to some features of Zoom if you're new to Zoom. So you have entered this meeting both muted and without a video on. That's just to help us preserve bandwidth so that you all can see the wonderful presentation that Katelyn has provided for us tonight. I want you to go ahead, if you haven't used Zoom before, and take your mouse and toggle along the bottom of your screen. That's going to bring up a small bar with a bunch of icons on it. You will go ahead and use what's called the chat feature to ask questions during the webinar at any time. So that chat icon looks like a little chat bubble. And if you just pop your question in there, we'll be able to answer that live. So just perfect. Thank you, Katelyn. And actually, before I go any further, are you okay with me asking questions as they come in, or would you like to wait till the end of sections?
Let's go as they come in. Otherwise, I don't want to listen to myself talk for that long. So
perfect. All right. So you heard it from her. Just pop your questions in as you've got them, and we'll go ahead and answer them. And without further ado, I'll hand it back over to you, Katelyn.
Great. Thank you, Amy. So welcome for those of you who haven't been on a FarmOps CCE seminar with Amy and myself. We work for Cornell Cooperative Extension. I'll share a little bit about our program and who we are. Tonight's seminar is a partnership between CCE and FarmOps. FarmOps is Cornell Small Farms Program Veteran Education Initiative. If you're not familiar with them, I would highly suggest and recommend you visit their website. Their seminars, trainings, resources, always updated on this website. We appreciate their support. They let us offer this webinar for all of you for free and specifically for veterans. Amy and I work for Cornell Cooperative Extension Southwest New York Dairy, Livestock, and Field Crops team. It's a partnership between Cornell University and the 5 CCE associations of Erie, Chautauqua, Cattaraugus, Allegheny, and Steuben counties. We are a team of 4. We primarily focus on resources, support, and outreach for dairy, livestock, and field crops producers. I'm a farm business management specialist, so it's really hard to try to find a picture that accurately represents paperwork. So this is a pile of paperwork. Amy is our livestock and beginning farm specialist. We also have a field crops and forage specialist and a dairy management specialist. We do primarily work within our Southwest New York corner, but if you have any questions about any of the topics that we present on, just reach out to us and we'll either be able to help you out or connect you with the person in your region that is able to help you. So tonight, I'm going to be primarily talking about taxes, but Amy is on board to help out. So if you have any questions, drop those in the chat and she'll help me keep an eye on that. I'll also say too that Amy and I are both farmers outside of our day jobs here at CCE. So we've been in your shoes. We hate filing taxes just as much as you do. So you get a little bit of the CCE side of us and a little bit of like, this is what happens in real life side of us. A quick disclaimer, since we are talking about taxes. I'm not an accountant. I'm not a certified tax preparer. I'm not legal counsel. I'm here to provide you with educational information that is the most up to date that I know of, but I'm human and we still definitely encourage you to reach out to a certified or reach out to a professional tax preparer when it comes to questions around submitting taxes for your farm. Okay, if you have any tech issues, you can jot down these numbers. The first number is my number, second number is Amy's, so 716-640-0844. If for some reason you get knocked off of the Zoom, go ahead and give her a text or a call and she'll help you get back on here. We are also recording this, which is why we've got your video and your sound or your mic turned off just to help with that recording. Everyone will be receiving a copy of this recording as well as the slides. So don't feel like you have to jot everything down that are in the slides. And last housekeeping thing that I want to mention really quick is, like I mentioned, this is a partnership between our program and FarmOps. We've got several other seminars happening this year. Coming up next week is Protecting Against Murphy's Law. So we're going to talk about all the things that can go wrong on your farm and how you can help protect against them. So that's going to be happening next week on Wednesday, the 29th. And if you're not available that night, we'll also be recording that one too. Then we're going to get into some more topic specific. So Amy's going to be leading us through backyard beef on April 26th. I'll be doing minding your marketing P's and Q's. So all about designing a marketing plan for your farm that makes sense. We'll be talking about raising poultry for meat production, farm diversification, and more. I think we've got a couple other topics earmarked for goat production, some more chicken topics, and whatever you guys need. So at the end of this seminar, there will be a survey that pops up and you can fill that out. And one of the questions that we ask is, are there any other topics that you're interested in learning about? And this entire list are topics that people said, I really want to learn about this. So we really do listen to you when you say, teach me about X, Y, and Z. That's what we're here to help you with. All right, that is all of my housekeeping. So we're going to jump right into small farm tax basics. Caveat to this is that there's nothing fun about taxes. There are no fun pictures. There are no fun videos. So for those of you who have been through our goat trainings, we have fun videos of goats and here's how you do this, this, and this. There's nothing like that in taxes. So this presentation, it's rough. So please, as you have questions, drop those in the chat. If you want clarification, if you heard something different than what I'm telling you, this space is really, really here for you. And hopefully by the end of it, we'll save you a little bit of money too, which is good. So we're going to talk, we're going to bring up this question a lot of like, does this apply to me? And the answer is usually yep. And that's basically what my presentation is. But again, please ask questions and use that chat box as we go along. We're going to talk a little bit more about clarifying who actually needs to file farm taxes. And for those of you who participated in our farm financial resolution, some of this will be a little bit of an overlap. Then we're going to talk about what to file for your taxes. What's the form you have to use? How do you do it? I'm going to hopefully help save you some money. And then we're going to have lots of time for getting started with just a variety of different topics and further resources. And again, like I mentioned, there's going to be a little evaluation that pops up at the end of the seminar. Please go ahead and fill that out afterwards. All right. We've got a poll question that I wanted to pop up here. So if you could go ahead and answer, let us know, is your farm currently actively farming? So are you currently actively producing food or fiber or another agricultural product? So your options are, yep, we've already done it. Yep, this is our first growing season coming up. Not yet, but we're getting there. Or my favorite, no, and I'm not really sure how I landed on this Zoom webinar, right? Go ahead and fill that out. Looks like we've got most people in. I'm going to go ahead and share. So we've got a good mix. We've got about half people, a little bit more than half that have already been farming for a little bit. And then the other half of folks, this is your first year or you're just getting started. So welcome. Hopefully everybody, well, I'm relatively certain everybody's going to walk away learning something after this seminar. All right. So the first question that I like to start with is, am I a farmer? Right? How do you know when you're a farmer? And especially when it comes to taxes. So if you ask me, I think that you're a farmer as soon as you say you are. There is no license that you have to apply for to be a farmer, right? You just wake up and you decide you're a farmer. Although Amy and I have talked about making up fake licenses and trying to sell those to folks for our retirement gigs. So maybe that'll be a future. That's a joke. That's an absolute joke. We're not terrible people. But there's really, really no license procedure application for you to be a farmer. You decide you're a farmer, great. But when it comes to filing taxes, there's a few other guidelines and regulations that we look at. According to the federal government, you're a farmer as a farm business if you sell more than $1,000. Now that's sales, that's not profit. Or you complete a Schedule F. So you can file a Schedule F, which we'll talk about what that is, without actually bringing in any income. So if you're a beginning farmer, for example, and you're heading into your first season of planting blueberries, right? You're not going to sell any blueberries. You're not going to have any income for your blueberry farm, but you can start filing your taxes as a farm business without that income. You don't need to make a profit to be a farm business. You don't need to have a business structure. So you don't have to be an LLC. You don't have to be a corporation to be a farm business. And you don't need to have a farm ID. Your farm ID can just be your social security number. We'll talk a little bit why that is. According to the state government, New York State, for the most part, follows IRS guidelines for whether or not you're considered a farm business. According to most grant opportunities, loan opportunities, some tax credit opportunities, you have to have $10,000 in sales. And again, that's sales, not profit. And that's how you end up qualifying for something called the Ag Value Assessment, which is typically like the first goal, I would say, for when you're starting a beginning farm. So are you a farmer? Do you sell food or fiber? Do you sell food or fiber for more than $1,000? And then the next step is getting to that $10,000 number. If you are in that group of folks that is here working on starting your farm, there's an 8-step process that we follow. This is not research or scientifically based. This is just what Amy and I tell people that they need to do to start a farm. So the first thing is just trying to decide why are you farming when you could not be farming? Inventorying your resources, making a business plan, making a marketing plan, legitimizing your business, setting up a record keeping system, building your network of people, and then continuing to reevaluate and grow. The steps of this starting a farm that most apply to taxes is legitimizing your farm business. Filing your taxes for your farm is a way to legitimize what you're doing as an actual business. Actual businesses file taxes. Hobbies do not file taxes. So if you are really serious about operating your farm as a business, file your taxes. If we think about legitimizing and structuring our farm, there's a few quick steps that you can do if you're just getting started. And if you already are farming and you haven't done these steps, take a step back and do these really quick. The first one is to decide on your business structure. So there's a few different options. We talked about these in our other seminars too. And I'm happy to help walk you through what would be the best fit for your farm. There's a few different options. So sole proprietorship, partnership, LLC, S Corp, etc. I 9 times out of 10 recommend that farms start out as a sole proprietorship. I think in the past, there was always this idea of start as an LLC so that you can't get sued and lose your house. But unfortunately, there really isn't that much liability protection with an LLC anymore. And it's a whole bunch of extra money and paperwork to do that. So I'm happy to help continuing to have the conversation of LLC versus sole proprietorship too. But I just wanted to highlight the fact that you can start a farm business as a sole proprietorship. I saw a couple of questions come in. Will we get the slides separately or the whole presentation or both? You're going to get the slides separately with all of the links active, and you'll also get the video. So don't feel like you have to write down everything. These are going to come to you in your email. Just keep track of the information that you want to remember the most or double check back in. Good question. Thank you. All right. If you file as a sole proprietorship, you're going to file something called a Schedule F on your regular 1040 income taxes. And that's what we're going to focus on tonight. After you decide on your business structure, I would encourage you to get a DBA, a doing business as. This is not required to do your taxes, but it is required sometimes, most of the time, to keep track of a separate bank account. So to establish a separate bank account for the farm, a separate checking account, this is really good, really important for filing taxes as a farm business. The advantage of having a separate business checking account is that you can run all of your incomes and your expenses for the farm business separate from your personal banking system. If, for example, you were ever audited and you didn't have this set up as a separate checking account, that's going to be a huge red flag. It is worth the monthly maintenance fee of, sometimes it's usually like $2 or $5 to have a separate checking account. And then last step to legitimizing and structuring your plan is to make a business plan. And we do have room to offer a seminar just on business planning if folks are interested in doing that. Tax planning, income tax planning can sometimes be a really important part of your business planning because taxes are expensive. So how do we manage that expense on our farms? Then you file your taxes. And once you file your taxes, that's it. Like you have officially made it as a farm business in the eyes of the government. Okay, any questions so far about legitimizing or structuring your farm? Keep an eye on the chat for anything related to that. But as I mentioned, typically starting out as sole proprietorship is usually okay. We've got an interest in business planning. Good. I know that was a topic that we were on the fence about offering, but we've had a few requests for it. So we might end up pulling that one together later this spring. All right. The biggest question that I get when I start talking about farm taxes, and particularly for beginning farmers, is determining, are you a farm or are you a hobby? There was a question too that came in, is this workshop still relevant if we're not a sole proprietorship? Yes. If you are an LLC or a partnership, you're typically still filing a Schedule F. It's just reported on your personal income taxes a little bit differently. And Christina, hopefully that answers your question. And if it doesn't, you can let me know too. One of the first questions that we get asked is, am I a farm business or am I a hobby? The reason that this is important is if you are a farm business, then you file a Schedule F, either as a partnership, as an LLC, as a sole proprietorship, where you're claiming your incomes and your expenses, and you're paying taxes on the profit that you receive. If you file, if you're operating as a hobby, you can still file that income on your taxes, but you cannot write off the expenses. So it's advantageous, if it makes sense for you, to operate your farm as a farm business and be able to file your taxes accordingly, because then you can write off the expenses associated with that farm. The IRS has 9 considerations to determine whether or not you're a farm or your hobby. This is not an accurate representation of the IRS, but in my brain, this is what I think they look like, right? If I had to generalize an entire government agency, this is the IRS. So the 9 considerations really quickly is the farm managed in a business-like manner with complete and accurate books and records. So this is keeping track of your incomes, your expenses, having a separate banking account, keeping track of animal records, planting dates, harvest dates. Do you put enough time or an effort into making a profit? So if it's a hobby farm, you're not really putting in time and effort to earn a profit. It's just there for your enjoyment. Do you depend on the income from the farm? Is this part of your family's household budget, or is just something that you do on the side, and whether or not the farm makes a profit doesn't really matter to you? If you experience financial losses, are they normal or are they intentional? So if you are using a farm business as a way to offset off-farm income, and not to manage it to intentionally earn a profit, then at that point you're a hobby. That's not a farm business. If you are a farm business and you experience a financial loss, that is normal. And most farms do experience financial losses in some years, then you are operating that as a farm business. If you're currently not making a profit on your farm, are you making changes to improve so that you could be earning a profit? Do you work with advisors, somebody like me, somebody like Amy, somebody like your loan officer, to improve decision-making and management skills? Have you made profits before in other businesses? Does the farm make a profit sometimes? And how large is that profit? There's a rule out there, 3 out of 5. It's not necessarily a rule, but it is a good rule of thumb. So if you operate a farm business and you earn a profit every 3 years out of 5, what that means is that if the IRS was ever questioning whether or not you were a business or hobby, and you could prove that you earned a profit for the past 3 out of 5 years, then it's on the IRS's shoulders. They have the burden of proof to show that you're not a farm business, you're a hobby. And typically that's pretty hard if you're claiming a profit. If you have never claimed a profit before, or it's only rarely that you claim a profit, then the burden of proof to prove that you are a business and not a hobby is on you and not the IRS. It's a little bit more difficult to justify that you're operating that as a business if you can't show that you've earned a profit. And then the final consideration is if the farm's currently not receiving a profit, so you're a beginning farmer, is there an expected profit in the future? This isn't something that I made up. This is these are actual IRS guidelines. This is the link if you wanted to read it word for word. I think another key consideration is you're less likely to be flagged as a hobby the more sales that you claim. So getting to $1,000 in sales is how the USDA federal government classifies you as a farm business. Getting to the $10,000 in sales is another way to safeguard that you are operating as a business and not a hobby. Okay, so the next question that we have is to find out if you think that your farm is a business or if that your farm is a hobby. Or if you're still not sure, that's okay too. I'll leave this pull up here for a second. And looks like we got most people in. So looks like most people here are operating as a business or qualify as a business. We've got a few hobby folks and a few people that still aren't sure. For those of you who are operating as a hobby, at that point, you will not file a Schedule F. So when you're operating as a hobby, you'll work with your tax preparer. You can still claim the farm income as income so that you don't have to worry about like hiding that income, right? But you cannot claim the expenses against that income. However, I think that it's important to honor the fact that you don't have to be a farm business, right? Like there's this fear of missing out. Like if you're not getting every tax credit you can, then you're a bad person. That's not true. You can operate as a hobby, as a way to provide food for your family and your friends and your local community without that stress of I have to earn a profit, I have to earn my taxes, I have to keep these records as well as I can. So if you're operating your farm as a hobby, you won't file a Schedule F, but you can still work with your tax preparer to claim that income on your taxes. Okay. Now I want to know if you are currently filing a Schedule F for your farm. Oh, that's not the right one that popped up, is it? Hold on, maybe it's not in here. There we go. Okay, so do you currently file a Schedule F for your farm? Yes, no, or I'm not sure. It will show up on your taxes. If you're an LLC, it's pass-through income. Partnership, same thing. If you're a sole proprietorship, it's usually a schedule that's buried within your 1040. Okay. Looks like we've got a good mix. So half of us are filing one, half of us aren't, and a couple of folks aren't sure. That's okay too. Depending on your tax preparer, they might have automatically filed a Schedule F for you without you knowing that you were, and that's okay. Okay. So we keep talking about Schedule F. What is a Schedule F? Let me go ahead and show you what this is. Amy, can you just let me know, did it switch over to the browser screen?
Yep, we're good to go. I would increase the size a little bit though.
It's
hard to see.
Do that. There we go.
Awesome.
Thanks. So this is a copy of a Schedule F. This is exactly what you would file on your taxes. A Schedule F is called profit or loss from farming, and it's attached to your 1040, or whatever form you're filing based on the business structure of your farm business. If you're operating as a sole proprietorship, there will be the name of the proprietor, which will just be you. If it's you and your partner who are filing jointly, married, filing jointly, usually still just one person's name goes on this form. Instead of having an employer ID number, you can usually just use a social security number. If you don't have employees on your farm, you don't need an EIN. So your business ID, your tax ID at that point is just your social security number because you're filing as a sole proprietorship. Next thing you'll do is you'll list out what crop you're growing, and there's various codes that are standardized that your tax preparer will help you fill out. And I'm just going to scroll down this briefly because we're going to actually go in depth into each section. But part 1 is listing all of the income for the farm by various sources. And then part 2 lists all of the expenses for the farm business from various sources. You add up the income, you add up the expenses, and you subtract. If it's a profit, then you are taxed on that profit. And if it's a loss, then to a certain extent, that loss will decrease your personal tax liability. So what does that mean? You're taxed on your profit? It means that whatever that number is, you're going to get taxed on it as income. So if you earn a $10,000 profit, it doesn't mean that you're going to pay $10,000 in taxes. It means that you're going to pay whatever tax bracket you're in, which we'll talk about in a second, that percentage of your profit. So if you are in a 20% tax bracket, you will pay $2,000 on that profit. Profit on a Schedule F doesn't mean you lose all of your money as taxes. It just means that's your taxable income. Alternatively, if you have a loss to an extent, it's not always a 1-for-1. You have to work for your taxpayer. So let's say your farm loses $10,000. You have an off-farm job that brings in $50,000 a year. Your new taxable income is going to be $40,000. And it doesn't always work like that 1-for-1. You have to work with your tax preparer, but that just gives you an idea of how that works. And that's it. That's the Schedule F. Most farm businesses use something called cash accounting, which we'll talk about in a little bit. This backside is if farms are using accrual accounting. And then these are the accounting codes for what type of farming you're involved in. Seems pretty simple, right? Seems like we don't need a whole hour-and-a-half course on this topic, but because it's taxes, it's not simple at all. Couple other things to think about when it comes to the Schedule F is that the Schedule F is used as business proof. So because there's no license to apply for to start a farm, the Schedule F is how you prove that you're operating your farm in an above board way, that you're claiming the incomes and the expenses as a farm business. At a minimum, keeping track of your records, farm records, to file a Schedule F is important, and that's what we would consider the minimum level of financial record keeping. We use the Schedule F to record business incomes and expenses. And this, again, is for farms that are operating as a business. If you're operating as a hobby, you won't be able to fill out the Schedule F. If you are like me and taxes interest you, there's something called we call it Pub 225, and it's the Farmer's Tax Guide. This comes straight from the IRS, so you know it has accurate information. And I just lost it. Give me just 1 second. There we go. It is 96 pages long, 96 pages long, but it has every single answer to every single question that anybody ever has about filing a Schedule F. talks about what records to keep, how to keep track of them, what counts as income, what counts as expenses, what to do with things like depreciation, capital gains, installment sales, thefts, self-employment taxes, employment taxes, credits and refunds, estimated tax, and how to get tax help. It is all here in 96 pages. The rest of my presentation is based on this guide. And if you ever have a question that you can't find the answer to in here, then it's probably something that you need to call your accountant for ASAP, because it might not be applicable. I would encourage you, if this is something that you're interested in, just browse through it. You don't have to read the entire thing, but even just jumping to what is a deductible expense, there's really great examples that run you through. You bought fertilizer, you bought feed, you bought seed. Here's what that looks like on your Schedule F. Talks about prepaid expenses and what counts and what doesn't count. So I definitely would encourage you to take a look at this. And again, the link will be right here in your slides.
Caitlin, we do have a question that came in. So once you file a Schedule F, do you have to file it annually?
As long as you are operating your farm as a business, you have to file a Schedule F. So if you're, let's say you start out filing a Schedule F, and then you decide that your farm isn't really a farm and you want to operate it as a hobby, or you want to quit operating as a farm or having a farm at all. When you switch from filing a Schedule F to not filing a Schedule F, you do need to work with your accountant to make sure that, for example, if you have a bunch of tractors and you sell those tractors because you're getting rid of your farm, then you're taxed on that sale. Capital gain sale is what it's called. So you need to work with your accountant. So it's not like once you start filing a Schedule F, you're doomed and you have to do it forever, right? But you do need to do it for as long as you're operating your farm as a business. If you start filing a Schedule F as a farm business and then you decide, I want to hide this money and go off grid and not file taxes on it, and you quit filing a Schedule F, that could potentially raise a red flag. If you start filing a Schedule F and scale back your farm or quit farming altogether, then you do need to work with your tax preparer to manage that transition out of farming. But it's that transition out of filing a Schedule F is there, and it exists, and there's support and structure to do that. So it's not like you have to do it forever. You just need to file it as long as you're operating your farm as a business. And Marjorie, if that didn't answer your question completely, let us know too. So now we're going to talk a little bit about what counts as incomes on the Schedule F, what counts as an expense, and how to know which pieces will work for your farm. So incomes on the Schedule F include sales of farm products, foods, and fiber. These are items that you grew or raised on your farm for sale, or items that you purchased and sold within the same year. So if you buy a goat at the beginning of the year, a goat kid, you feed that goat kid and you sell it at the end of the year. Even though that goat kid wasn't born on your farm, that still counts as an animal that you raised on your farm. So that would count as income that you would claim. If you have livestock that you hold, but you don't plan to sell them, so brood cows, right? If you're raising beef cows, for example, those aren't considered incomes. Having that cow, at that point, it's an asset, right? So an asset is something that you own. An income is cash that you received for something. Other incomes are rents. If you have farmland that you're renting out to another farmer, that's a farm income. If you have a building on your farm that you're not using, that you rent out to somebody else, that can also be considered farm income. If you have extra pastures, agricultural program payments, including CFAP, if anybody received CFAP over the past couple of years, that counts as income. But cost sharing conservation programs don't cost as income. Basically, if you're applying for free money in the form of a grant, government assistance program, even things like crop insurance, particularly the subsidies, ask if it's taxable income first. because it probably is. And all of the specific programs that are offered through like the USDA or FSA are listed in the Pub 225, the Farmer's Tax Guide, so you can double check there too. But if, for example, if you're applying for a grant, always ask, is this considered taxable income? Because it probably is. Other incomes include crop insurance payments, income from a co-op. So if you're part of a cooperative or a collective marketing group, and you receive income from that, you can get income from those, or that income counts as a income that you claim on your Schedule F as well. We had a question pop in. Does New York State Department of Taxation and Finance have its own equivalent form to the IRS Schedule F? Or does it accept the IRS Schedule F? It accepts the IRS Schedule F, and you pull that same number into your state tax form. I bet you didn't expect that answer, but it's actually a little bit more intuitive than some other federal versus state tax filing requirements. Other incomes on the Schedule F, cancellation of debt. So if you, PPP was a great one, but it's not a good example. Let's say that you had a loan from the USDA and the debt was canceled. That could be considered income. If you claim bankruptcy for the farm, that could be considered income. If you barter goods, so I give you half a cow and you give me 2 goats, then that is considered income. So I would value the half of cow that I gave to you or traded for the 2 goats as fair market value. And you would value the 2 goats at fair market value as income on your end. If you do community futures, commodity futures, or options, those are considered income. Sometimes if you have an easement or right of way or some type of receiving some type of payment for farmland, it sometimes is considered a farm income, and it sometimes is considered a personal income outside of the farm. So you need to work with your tax preparer to clarify which one's which. If you're doing any type of custom hire, that is considered farm income. So let's say you own a tractor and a baler, and you bale your own hay for your farm, but then your farmer neighbor wants you to come and bale his hay and he pays you to do that. That's considered farming income. Any prizes or awards. So if you enter your blueberry jam at the local county fair and you win your $2 premium, you best be claiming that on your taxes as taxable income. Any refunds or reimbursements, those are all considered incomes. Incomes are usually a little bit easier because farming does use cash-based accounting. With cash-based accounting, anytime that money comes in or leaves your account, that is considered an income or an expense. So if you're receiving money at some point for something related to the farm, that's a qualifying income that you would claim on your taxes. Sometimes slightly more confusing is the expenses. Expenses that you can claim on your Schedule F against your farm income are considered ordinary and necessary costs of operating a farm for profit. To an extent, if you can justify an expense as an ordinary and necessary cost, it's something that you can claim on your taxes. There are examples of personal and business shared expenses. So some examples of that are water, electric, phone, insurance, interest, and taxes. For example, if you have a shared utility electric use for your home and your farm, so let's say you pay $2,000 a year for your electric, you can cost share that and claim a portion of it for your farm. If you use your cell phone for farm marketing to call customers, make butcher date appointments, post about your farm on social media, you can claim a portion of your phone expense. If you own land and you pay property taxes on that land and you're using that land for farming, you can claim a portion of the property taxes as a farm expense. Another good one is insurance. So typically farms have whole farm policy insurance plans, and they typically also cover your home that's on the farmstead. You can claim the farm portion of the insurance as a farm expense. The not so great news is that there is no set allocation out there. So it's only what's reasonable. Most tax preparers will have kind of what they feel comfortable encouraging folks to claim. Some of them you can figure out. So taxes, you usually can figure out. If you go back to like your itemized assessment, it'll say this field is assessed at this, the house is assessed at this, the garage is assessed at this. So in that case, you take out the assessed value for the house and the garage, and then proportionately figure out like what part of the taxes would just apply to the farmland. For phone, that one's a little bit tougher, right? So if I'm on Instagram scrolling, does that time count as farm marketing, or does that time count as personal use? Electric is also a little bit tougher, especially if you don't have a separate pole for your farming operation. But like I said, most accountants will have an idea for what they want to use. I see the question. There's a question that came in. What about money raised through fundraising and crowdfunding? Is that taxable too? This is a really tough question, and I would say that you need to talk to your tax preparer. There are several different things that come into play. So was this like a charitable fundraising, or was this considered you're seeking investments to start your farm? Another consideration as well is the amount that was generated through crowdfunding or fundraising versus the whole size of the business. I've seen it go both ways, and I hesitate to say it's always this or it's always that, because it really does depend on the situation, and it does depend on the amount, and it depends on how that money was collected. So I would encourage you, unfortunately, to talk to your tax preparer for that. The next question that came in. Yes, thank you. Okay, so folks may be able to apply for a residential agricultural discount via their electric company for electric too. You're stealing my thunder. This is how I save people lots of money. Thank you, Heather and Mike. So for those of you, for most electric companies, there is something that you can get on your electric called residential agricultural discount. What it does is it gives you a credit on your electric bill if you can prove that you are operating a farm business on that parcel of land that's receiving the electric. So for example, I'll give you a really quick example. I have a farm. Our electric bill is usually around $200 a month. We receive the residential ag discount, and that can be anywhere between $50 and $80 a month. To apply, the application is due on July 1st of every year, or maybe it's June 1st. I can't remember now, so don't quote me on that, but this will be included in your resources. You have to apply annually. You have to provide a copy of your Schedule F annually, and then that credit is applied once they receive your application. It's a really cool kind of perk, a way to save money if you're operating your farm business along with your home where you're receiving a electric service. I think that's the right word. Sorry. I don't speak electric, right? I don't understand. Like, it just shows up, and I'm really grateful for it every day. But thank you guys. That was a really good thing to point out. Any other questions at this time? Okay, another question. Can you speak on New York State Form ST-125? Can you discuss its use to purchase equipment or materials and how it applies to us? The ST for the AU-11, I have to double check on that because I have heard of it before, but I'm not familiar enough with it to talk about it off the fly. So when we take a break, I'll look it up quick in my farm business management files here. So the ST-125, there's a couple more slides on this later on in the presentation, but basically what it is it's a New York State form. So as a New York State farm business, you could be eligible to use the ST-125 when you're making purchases related to the farm. The ST-125 allows you to make sales tax-free purchases. So what you do is you fill out the ST-125 and you take it to the vendor. Let's say you're going to Tractor Supply and you're buying feed for your farm business. You file the ST-125 with the farm or with the vendor, and then you don't have to pay taxes when you make that purchase. This is really helpful when you're buying big ticket items like tractors, right? Or an ATV. As long as you are using whatever you're buying for more than 50% of its use is being used for your farm business, then you, and you're operating as a farm business, then you can use the ST-125 to not have to pay sales tax at the time of purchase. Oh, thank you. Thank you. I was like, wait, I know what this is. And now I can't remember. AU11 is reimbursement for sales tax if you weren't sure or forgot to use the ST-125. Anything that you could have used the ST-125, but you didn't, you can file that to get a credit on your taxes back for the sales tax. Typically, if it's something really small, it's not worth the filing fee that your accountant is going to charge, your tax preparer is going to charge. But for something big that you didn't get the ST-120 or you didn't have the sales tax removed, it is helpful to go ahead and file that too. You can start using the ST-125 as soon as you are operating your farm as a business. So even if you haven't filed a Schedule F yet, right? Let's say you didn't file a Schedule F for 2022 and you're thinking about filing it for 2023. You can start using the ST-125. When you fill out the ST-125, give me just a second here. We'll just talk about it right now. All right. The cool part about the ST-125 for New York State is that it's a really easy form to file. You include the vendor's name, so Tractor Supply and their address, and you include your name, the farm's address, and that's it. So you don't need an EIN. Some businesses will say, well, what's your farm's EIN? You do not need an EIN in New York State. You just need a copy of the ST-125. You select what it's being used for. Most of the time it's being used to purchase tangible property, so feed, equipment. And then at the bottom, you just sign it and print your name. You file this with the vendor and you can select if it's a single purchase or a blanket certificate. Most of the time you select blanket certificate, particularly if it's a business that you're continually buying stuff from. So if you buy all of your maintenance supplies for your farm equipment from a specific vendor, you file this once with them and just select blanket certificate. I honestly, best thing that I do is I print this out and I leave several copies in the glove compartments of all of our vehicles. So if we end up someplace where we don't have an ST-125 on file, I can fill this out really quickly and leave it with the vendor and not have to pay sales tax on that purchase. Follow-up question: to use the ST-125, you'll have to eventually file a Schedule F, correct? I would say yes. So the thing about the ST-125 is that it's definitely abused, right? There's definitely people who are using it for their hobby operations. I sometimes see it being used by folks who maybe have a small farm, but then they also have a construction business, and they use the ST-125 to purchase equipment for the construction business, saying that it's for the farm. So it's definitely abused. The fines, though, for finding out that you misused the form are really high. So it's best to not start using the ST-125 until you are going to file your taxes, right? So if you're operating as a hobby, it's not worth the risk of using the ST-125. If you have been operating as a hobby, but you plan on filing your taxes, start using the ST-125 for this year if you're planning on filing your taxes for 2023. If you go back and you start filing your taxes for previous years, use the AU11 to receive back sales tax credit. Any other questions about the ST 125? Okay, another question that came in. Do you need to do anything from your side beyond handing the seller the form, like keeping a record for yourself? You do not. So you should keep the receipt that you receive, and usually the receipt will say this was a sales tax exempt purchase, but you don't have to keep track of anything. You don't get like a copy of the form for you to keep for your records. The vendors keep these for their records, so that then if they're ever audited, if they ever receive a sales tax audit, then they will have to go through and just verify that everybody that they collected an ST 125 from is in fact sales tax exempt. Alternatively, if you are selling products to somebody and they're sales tax exempt, then they might provide you with an ST 125, and you should keep that on hand indefinitely. All right. Any other questions about ST 125s? Okay. So other expenses that you can claim on your Schedule F include prepaid farm supplies. So I mentioned that farming is cash-based accounting. So as soon as cash leaves your farm account, you can claim that as an expense. So if you prepay for fertilizer in 2022, even though you're not going to use it until 2023, you can claim that purchase as a 2022 expense. Hired labor wages are tax. You can claim those on your taxes. Repairs and maintenance, interest within some limits. So let's say you have an equipment loan that you pay interest on, you can claim the interest off of that. You cannot claim the principal payments. Fertilizer and lime, farm business taxes. So if your tax preparer charges you $200 to file your Schedule F, that's actually something that you can claim as an expense. If you make a purchase and you pay sales tax on it, you can claim that sales tax. So it'll go in as an expense on your farm business. Highway use tax, you cannot deduct self-employment tax. So if you end up paying taxes on your farm income, you can't deduct that expense because that's considered a personal expense. But if you pay property taxes on land that you use for the farm, that's a valid expense that you can claim on your Schedule F. Other examples of expenses include insurance, particularly the farm share of property insurance, liability insurance for your product. If you purchase crop insurance, livestock insurance, health insurance for farm employees, all of those are qualifying expenses that you can claim. You can claim rent payments on land that you might be renting, and then we can do something called depreciation for larger expenses, which we'll talk a little bit more about later. These are for purchases that have a useful life of more than 1 year. Okay, other things that you can claim are truck and car expenses. So you have two different options. If you own a vehicle that gets used sometimes for personal use and sometimes for farm use, you can either claim truck and car expense or you can claim mileage. The difference is mileage, you track all of the miles associated that you use your personal vehicle for your farm business, and then you get paid the federal mileage rate. So 2022 was 0.625 cents or dollars. So 62 cents for every mile. If you use the actual cost, then you keep track of all of the gas, tires, oil, repairs associated with that personal vehicle, and then you allocate a portion of it as a farm expense. Most of the time, because we're farmers, so we figure out a way to fix most things, charging mileage tends to be more advantageous for farms. So keep a mileage log in your vehicles and track the miles that you do for farm business purposes, and you can claim that on your taxes. Travel expenses. So if you're traveling to go to an overnight training, you can claim those as a farm expense. If you get any marketing quota penalties, this is typically for our dairy producers. If you purchase items that you resell within the same year, within reason, this can be listed as an expense on your Schedule F. So let's go back to you buy a goat, you feed it, you sell it within that same year, or within a year, that is considered a valid expense. Any accounting, record keeping, or attorney fees related to the farm are qualifying expenses. Any advertising fees, consultant fees, cooperative dues, educational expenses. So if you attend a CCE workshop, you can claim if there was like a registration fee that could go towards your qualifying expenses. If you have any farm magazine subscriptions that you have, memberships, so if you're like a member of Farm Bureau, your annual dues can count as a qualifying expense. Any insecticides and chemicals are qualifying expenses. Bedding, marketing fees, service charges, stamps, small tools, loan expenses, tax preparation, but capital expenses, we'll talk a little bit more about later. So again, anything that is considered normal, ordinary, necessary for your farm to operate is a qualifying expense that you can include on your Schedule F. So I see a question, can you claim travel to and from your farm if you don't live on it? This one's a really tough one, and I would say you need to get that clarification from your tax preparer. Usually you can't, because it's considered commuting miles. But sometimes talk to your tax preparer so that I don't get you audited. Sometimes depending on what's considered your home farm and what's considered a satellite farm can come into play. And I would encourage you to clarify with your tax preparer for what they feel comfortable with given your situation. All right. Any questions about other questions about different types of incomes and expenses that count as qualifying items for your Schedule F? I feel like I just talked for a super long time because I did. Okay. This is my friendly public service announcement. Just because you can write it off doesn't mean you should buy it. So I work with a lot of people who make the comment, oh, I can just write this off, so it's not a big deal. But just because you can write it off doesn't mean that it's a good business decision for your farm if you're operating your farm as a business. If you are making decisions without thinking about how that fits into your farm business's profitability, you could be working yourself into a situation where you're making decisions for tax management purposes that don't positively impact your profitability. Where I see this a lot is on farms who make more purchases than what they bring in for income so that they can claim a loss on their farm to decrease their taxable income, particularly if you have off-farm job. However, businesses that are operating as a business don't year after year make more expenses than they bring in this income. They're not always experiencing a loss on their farm. Profitability is really important, and there's a difference between making sound business decisions and making decisions to avoid paying taxes. So the idea of, oh, it's a write-off, it doesn't matter, it's still your money that you're using to buy that. So even though you can write it off, it's your money that you have to use to pay for it. It's not free money. I see this happen a lot too with people who are like, if you get to the end of the year and you realize that you might end up claiming a profit, the December 31st tractor purchase, right, made entirely to avoid paying taxes, can create cash flow issues later on. could you afford that tractor? Like, is that purchasing that tractor a good decision for your business from a business planning perspective? Yes, maybe it was a good decision from a tax planning perspective, but these are two separate questions. So profitability and profit is something that sometimes makes farmers feel icky. And I think it's because there's this idea that if you're making a profit, you're a bad person because you're in it for the wrong reasons. But you have a limited amount of dollars and a limited amount of time. And if you're not making a profit, why are you doing this? Right? Earning a profit doesn't make you a bad person. It makes you a person who is able to buy groceries. I have to laugh a little bit. So Amanda commented, tractors are always important if they are orange. And we are both from Alice Chalmers Proud Tractor Farm. So I guess that I should put a little asterisk that if it's an orange tractor, then I fully support that purchase. I'm just kidding. It should still be a good business purchase. So let's talk about making a profit. Profit can make you feel a variety of different things. And I find that in the agricultural world, earning a profit can sometimes be considered a bad thing, and it shouldn't be. And here's why. Most of the time, if you've ever gone to a business 101 workshop, you see the profit equation presented as this: income minus expenses equals profit. So we are a farmer, we sell products, it costs us money to raise those products. And hopefully at the end of the day, if we take our income and we subtract our expenses, there's money left over for a profit. So it's as if earning a profit is out of our control. But this isn't true. So I would encourage you to think about the profit equation like this. Profit equals income minus expenses. Put profit first. Thinking about profit doesn't make you a bad person. It makes you a person who is operating a business in a sustainable manner. Avoiding paying taxes at all costs and making purchases that aren't in the best interest of the farm isn't a great way to operate your farm. So go ahead and use the chat box. If you are a farm owner operator and you regularly write yourself a check that's steady, prevailing wage out of your farm business account that fairly compensates for all of your time, all of your labor, all of your management, all of your investment, go ahead and let us know in the chat. Right. I have never met a farmer who is consistently writing themselves a paycheck. Profit is your paycheck. When you own a business, having a profit is your paycheck. When you file a Schedule F, the profit at the end of your Schedule F is your income that you get taxed on, just like anybody else who has an off-farm job. Don't be afraid of profit and don't make tax planning decisions that are going to negatively impact your farm profit. Okay, that was the lecture that none of you came here for tonight. So I'm going to get back on the tax train, but I just wanted to mention that making good business decisions is sometimes different than making good tax decisions. Okay, so speaking about buying orange tractors, when you make a capital purchase or a sale, this is an asset or something that you buy that has a useful life for more than a year. If I buy feed, that is not considered a capital purchase. If I buy a tractor, that is a capital purchase. We treat capital purchases a little bit differently than we treat operational purchases. We do this by using something called depreciation. So we take the total cost of that purchase of the tractor and we depreciate it out over several years using an IRS provided formula. Land is not a depreciable expense, but you can claim your land taxes. If you're purchasing land as a business entity, then you should double check with your tax preparer just to make sure which one's which or what you should be doing. If you take a loan out to purchase a tractor, the interest that you pay on the loan is an annual operating expense. The payment that you make for the principal is not an operating expense because we're going to claim the expense of the tractor through depreciation. There's something called Section 179, which you should work with your tax preparer, so that in some cases you can, if you make a capital purchase, in some situations, you can deduct the entire purchase in 1 year. It's advantageous to do that if you have a year where you have a lot of farm income, and you don't want to pay taxes on that, then you can use Section 179 to make that December 31st tractor payment. But you should not do this without talking to your tax preparer first to make sure that it fits your business and that you are going to follow all the guidelines. The depreciation schedule that the IRS uses makes no sense to anybody. I mean, I'm sure it makes sense to somebody, but it doesn't make sense to me. If you're interested in seeing how the IRS depreciates out different types of equipment, you can look it up in that ST 120 or the Pub 225 Farmer's Tax Guide, and it'll list different properties, different equipment, and what type of depreciation method you should use. If you are already filing your Schedule F, the depreciation schedule is about this thick for like one tractor purchase, because there's several different methods to depreciate out capital expenditures. And I would definitely encourage you to work with your tax preparer to figure out which one's going to suit your needs the best. So I've been talking a little bit about tax planning. Income tax planning is managing what you have to pay in for your taxes for your farm business. You cannot soundly match up income tax planning and business planning without these three things. So first, you need financial records. These are records, financial statements that you're tracking on a regular basis. Once a month, quarterly, you're preparing a profit and loss statement. You have an up-to-date balance sheet, and it makes it really easy to prepare your tax returns if you have adequate records. Solid bookkeeping. You are very clearly tracking your expenses and your incomes. You've got a safe location for all of your receipts that's getting updated regularly, and you're tracking changes to your balance sheet items. And then finally, a good farm accountant. A good farm accountant is worth their cost. When you're interested in finding a farm accountant, particularly if you've never worked with one before, understand what services they provide. Are they only going to help you file your taxes, or will they be available throughout the year for you to ask questions? Are they familiar with filing a Schedule F? Are they willing to work with you in audit situations? And is it somebody that you feel comfortable talking to? If you're looking for an accountant for your farm, a tax preparer for your farm, the best piece of advice that I can give you is ask a farmer friend. Ask who they use. Do they feel comfortable with them? And don't be afraid of the cost. So a good accountant, a good tax preparer will more than make up for their cost by preparing your taxes and making sure that you are doing things in a way that will help minimize what you have to pay in at the end of the day. All right. I'm going to skip through some things here because I already gave you my lecture, so I covered most of those slides. When I mentioned before that a farm loss will reduce your taxable income, this is how. If you have off-farm income in the form of a day job, annuity payments, anything else, that income is taxed at a tax rate based on the total income. So for example, if you're married filing jointly, both partners have off-farm jobs that pay $50,000 each, you're in the 22% tax bracket because your total income is $100,000. Now let's say the farm has a bad year and it loses $20,000 within reason, and it's not always a line for line item. That loss could drop you down to the 12% tax bracket. Similarly, if you are, if your only source of income is from the farm, and the farm earns a profit that year of $100,000, and you want to go from the 22% tax bracket to the 12% tax bracket, then you could make a December 31st purchase of a tractor for $20,000 and drop down to the lower tax bracket. When we talk about income tax planning, making end of the year purchases, balancing off-farm income with our farm income, it comes down to which tax bracket are we going to get in? I'll tell you though, chasing tax brackets and tax breaks typically results in losing more money than what you gain from switching out your tax break or getting every single credit that you can. So again, if we go back to just because it's a write-off doesn't mean it's a good decision. The next thing that I wanted to talk about, so I'm sorry that I'm skipping through some of these slides, but I want to make sure we get to this part. So if you have any questions, feel free to drop those in the chat. Remember what I said, the Schedule F is a way for you to legitimize your farm business. If you ever get to a spot where you want to take out a loan for your farm business, take out a business loan, lenders will usually require 3 years of tax returns to look at your Schedule F. If you have avoided paying taxes and have filed a loss for all 3 years, they're going to look at that business and say, this isn't a very good business. So we can use things like depreciation, like tax credits, like prepaid expenditures to decrease our tax liability without harming the profitability of our farm business. And the whole point of this slide is just to gently remind you that claiming a loss every single year could bite you in the butt later on. So now we're going to go through just a few different tax considerations that don't really fit in any other category, but I want to make sure that we talk about them. We've talked about determining whether or not you're a hobby farm or if you're a farm business that's operating with the intent to earn a profit. I talked briefly about cash versus accrual accounting. Most farm businesses that I work with use cash-based accounting because it's really easy. So you're recording cash as it comes in and cash as it goes out. However, it's not a great picture of profitability. So for example, if I purchased a bunch of fertilizer at the end of the year, and I'm not planning on using it until the next year, let's say I did this in 2022, my fertilizer expenses for 2022 are going to be really, really high, and it might make my profitability look bad. But I already have made this purchase that I'm going to use for my farm in the following year. So cash-based accounting is really great for tax purposes to take the burden off of us, but it's not a great measure of farm profitability. When we think about family expenses, so this would be like paying for your groceries, paying for childcare, you need to have a separate bank account to separate out your family expenses and your farm business expenses. Even if you're a sole proprietorship, you need to have a separate bank account. Technically, if you are raising animals, farm products, vegetables, etc., for your own personal consumption, the expenses to raise those items should not be included on your Schedule F. I don't know how many farms out there have separate items for, these are the 3 pepper plants that I'm growing for me, and these are the 30 pepper plants that I'm growing for the farmer's market, and I'm going to apply my fertilizer here differently from this fertilizer, and I'm managing these as 2 different things, right? Most of the time we're not doing that. The best piece of advice that I've ever received for this is for you to purchase farm products from yourself, from the farm. So for example, if you raise eggs and you produce 4 dozen eggs a day, you keep 1 dozen for yourself, you sell 3 of the other ones. Instead of writing a receipt for 3 dozen, write yourself a receipt. So buy your food products from your own farm. This is advantageous for tax purposes, but then it's also advantageous for you so that you can see how much it costs you to raise products that you're using for yourself. And then we talked about shared personal expenses. Okay, the next big bucket of tax considerations that drive me nuts are Form 1099s. So 1099s are when you pay over $600 to an individual, a non-corporation, a non-LLC, for rent or service. If you do that, they need to be issued a 1099. Where this happens the most is for rent payments. Let's say you're renting land from a non-farmer landowner in the amount of $800. You need to write that landowner a 1099. In order to do a 1099, you have to work with your tax preparer to have them filed by January 31st, and you have to have the social security number of whoever you're issuing the 1099 to, which can sometimes be a really tough thing to ask for. If you make a payment of $599, you do not need to file a 1099. You should not use 1099s for regular work. So if you have somebody that's working on your farm as an employee, you cannot pay them with a 1099. They have to be on payroll. Another thing to consider is if you have service providers, you need to ask for itemized bills. So let's say you work with a construction company that operates as a sole proprietorship business. That construction company might charge you $2,000 for fixing something on your farm. You have to ask for an itemized bill with the breakdown of the labor and the supplies. If the supplies were $1,500 and the labor was $500, great. You don't need to issue a 1099. If the supplies were $1,000, but the labor was also $1,000, then you need to issue a 1099 because that's labor is considered the service part and it's over $600. If you have already filed a Schedule F, and I just said these things and you're like, ooh, I needed to file a 1099 for that and I never did. Talk to your tax preparer. Sometimes it's more difficult to try to backtrack and fix things than just to pay the fine if something comes up later on. But do keep track of where your money is going, what types of payments you're making, and if those are qualifying 1099 payments. We talked a little bit about bartering. So if you're bartering products with other farm businesses, then you need to assign a fair market value and count that as income. The best way that I do this is by creating a paper trail. So if I'm trading somebody 2 dozen eggs for a gallon of milk, I'm going to write a receipt for 2 dozen eggs. They're going to write a receipt for a gallon of milk. I'm going to claim the cost of a gallon of milk. They're going to claim the cost of 2 dozen eggs. Creating the paper trail for bartering helps make sure that you're claiming everything how you need to be. Next thing that I wanted to mention is something called the Farmer's School Tax Credit. If you file a Schedule F or Schedule C for your farm business, you can receive a tax credit on your state income tax that could be equal of up to 100% of the school taxes you pay on the first 350 acres that you own or operate or pay on. And then up to 50% of school taxes paid on every acre over 350. That's a little bit confusing, right? But it can be a lot of money. It can be a lot of money. In order to qualify for the Farmer's School Tax Credit, 2/3 of your gross income needs to have come from farming for the past 3 years. If you have an off-farm job, the off-farm job almost always outweighs income from whatever income you're getting from your farm. If the farm is your sole source of income, then you're going to qualify for this because 100% of your income came from the farm business. We talked about depreciation. So this is taking capital purchases and dividing that cost over time on our taxes. You can depreciate out the cost of new buildings, but you cannot depreciate out the cost of land. Most animals you can depreciate out. So if you purchase a brood cow, for example, you can depreciate out the cost of that cow over time. Other things that you can do with purchasing livestock, if you purchase a brood cow this year, you can not claim that purchase this year, but when it comes time to sell that cow, you can claim the purchase of that cow in the same year that you sell the cow to help offset the income from the sale. Some plants you can depreciate out, particularly if you're purchasing things like fruit trees that are going to be longer lasting plants. And if you have a weird year where you have like a big spike in income in one year, but then the following year you're not expecting the same income, you can work with your tax preparer to defer income if there were extenuating circumstances. We already talked about the ST-125, and I have 2 more things to talk about, and then we'll wrap up for the night. The next thing is something called an ag value assessment. Ag value assessment is a way to significantly save money, and it's oftentimes a good goal for beginning farmers. Ag value assessment recognizes that agriculture requires a lot of land, and farmers have to pay a lot of property tax on that land. So you take the land and you tax it in an agricultural rate instead of an assessed market rate. In order to qualify for ag value assessment, you have to have more than 7 acres in farming production. You have to sell $10,000 worth of agricultural products for 2 years in a row. And then for every year after that you want to receive the ag value assessment. And it's sales, not profit. And if you're less than 7 acres, you have to have $50,000 in sales. If you're renting land, that rented land can qualify for the ag value assessment if there's a written lease. To apply, you go to your local soil and water conservation district office, get an up-to-date soils worksheet is what it's called. And then you apply through your county or your town's office of real property using the RP 305 is what it's called. These are typically due around March 1st every year. This is where that $10,000 number comes into play, because this usually significantly reduces property taxes, and it's a really great incentive for farms to get to that $10,000 number. Finally, there's something called the farm building property tax exemption. If you build a structure for the farm operation, you can be exempt from paying taxes for 10 years on that building. You have to have at least 5 acres of land. It has to be used to produce or store commodities, not process them. Employee housing has a question mark on it. It depends on the situation, and it can't qualify for residents of the families. So you can't use your house and apply for a farm building property tax exemption. Permanent exemptions are usually given to things like silos, feed bins, commodity sheds, milk tanks and coolers, and manure storage. Greenhouses sometimes have a question mark depending on the structure of the greenhouse. And historic barns that were built before 1936 can also qualify for property tax exemption. So what this looks like is you build a new barn for your farm, and you file that new build with your real property office, and they're going to process the paperwork so that you don't have to pay taxes on it for 10 years. Once you get past that 10 years, it's not considered a new build anymore, and it's usually taxed at a significantly lower rate. Finally, if you are a farm selling products that are required to collect sales tax, you have to obtain a certificate of authority from New York State to collect New York State sales tax. Food is not something that you have to collect sales tax on. Crafts are something to collect sales tax on. If you are selling ornamental goods, so things like pumpkins for ornaments, corn for ornaments, Christmas trees, those are all items that you need to collect sales tax for. I don't know why this slide did this. So if you think that your farm business is selling a product that you need to collect sales tax for, you need to do that sooner rather than later. And I'm happy to provide help on that for anybody who might need it. Okay, I just talked for way too long. So at this point, I'm going to take a breath, and you guys are going to put your questions in the chat box. Taxes are really tough. And I think that I'm really grateful every day for a good tax preparer, because they can answer a lot of questions that a computerized tax program can't, particularly for beginning farms, because as a beginning farm, you have a lot of startup costs, right? And not a lot of income. And it can be good to have a tax preparer that's there, that has been with you from the beginning, that understands what types of expenditures you can claim, which ones you can't, and how to structure them for your farm's success later on. Okay, so if you have any questions, please feel free to put those in the chat box. Grant funds received, where to report that on the Schedule F? Good question. It depends on what program you received the funds from, and you would work with your accountant to make sure they're getting put someplace. What I'll say is that putting incomes and expenses in the right category is sometimes less important than just making sure they've made it on the Schedule F. So if you put things on the Schedule F, then you're covering yourself. Like, no, I claimed it. I'm so sorry I put it in the wrong spot, right? Depending on what type of grant it is, it can sometimes go under other income. So if it's like a non-government related grant, I usually see them on other income. If it's a agricultural program payment, something that you might have gone through the USDA office, that would go under this line 4A here. The other part that we see it happen too is if you have farm expenses related to grant income. So let's say you got a grant from Soil and Water to do a barnyard project. You would work with Soil and Water and your tax preparer to decide if you claim that or if you leave that project off. So if you have all of the income coming in for a project and all the expenses going out for a project, I've seen it happen where that entire project is just left off of the Schedule F. And I've seen it where the entire project is included on the Schedule F. So work with your tax preparer because it does sometimes depend on specific programs. Also, that Pub 225, excuse me, lists out specific grant programs and where they should be listed. Another question, sales tax is the part that gets the best of me. A seminar on this would be great. I agree. Sales tax is really confusing, particularly as a farmer, because most of the time we really are selling food, right? But sometimes, depending on how we package and market that food, can change whether or not we have to collect sales tax. What my other thing that I recommend to farms when I'm working with them is do not file to start to get your sales tax certificate of authority until you absolutely need to. So if you have an idea of having a farm stand where you're selling produce, you're selling honey, but then you also want to make lip balm, right? Honey, not taxable. Lip balm, yes, taxable. The income that you're going to get from your lip balm will not outweigh the headache and paperwork associated with having to do your sales tax reporting. That has to happen quarterly. And if you miss it, you get fined. So I encourage farms to avoid getting their certificate to collect sales tax until they are 100% certain that they need to for their farm and that it's worth selling those products on their farm. Sales tax just terrifies me, as Amy knows too. So it's super annoying. All right, let's see here. Would you consider land clearing, cutting timber, mulching stumps to be a capital expense? Here's my favorite answer. It depends. It depends on how much that cost was and how that cost compares to other farm income and what the purpose of that was. If you are paying to clear cut 100 acres and it's a huge expense, then that's typically considered a capital expense that would be depreciated out over time. If you are cutting timber in a small area to marginally expand your pasture, for example, that would be considered an operational expense. So it really depends on the size of the expense as compared to your farm income. The other thing that you can think about it too is like, is this maintenance or is this so that I can drastically change my farm? So again, if you're doing a little bit of clear cutting, right? Clearing out a fence line, that's operational, that's repairs, that's maintenance. If you are clear cutting an entire field, cutting timber down to manage forests, a lot of timber down, and that's considered a capital expense. If you sell that timber, it can be considered a capital gain, and you should work with your tax preparer to make sure that that's recorded correctly too. Okay, here's the next question. To get to the $10,000 income, are my sales combined or does each commodity need to exceed $10,000 alone? For example, $2,000 for maple syrup, $500 from garlic, $7,500 in hay. For the $10,000 income level, it's combined. So it looks at your entire farm business as a whole entity. You can also include up to $2,000 in timber sales too. So if you are a diversified farming operation, you just have to get to $10,000 total on that income line on your Schedule F to start qualifying for ag value assessment and other grants and programs. As a follow-up question, do I have to charge sales tax on any of those? You would not, as long as it's staying in those forms. So with maple syrup, that's considered a food. Garlic is considered a food. Hay is a little bit tougher. So for the most part, we don't charge sales tax on hay because we're selling the hay to other businesses that are sales tax exempt. And this is kind of like a gray area in the sales tax world. So I should stop recording so that this doesn't get picked up, and then we could pick the recording again, but it's okay. For the most part, for hay, you don't collect sales tax. Where you would collect sales tax is if you were selling hay for decorative purposes or selling it to somebody who has one horse out back as a hobby, because at that point, they're not a business. You're not selling products to another business. You're selling products for purposes of other than producing food and fiber. What can timber sales account for of the $10,000 again? And it's $2,000 and I try to double check that number every year, but I don't think it's changed in a few years. So up to $2,000 worth of timber sales can count for the $10,000 for like ag value assessment purposes. Okay, next question. Do you have resources of what farm products qualify as exempt for sales tax versus not? Yes, we do. So let me go ahead and share with you what I use. There is a really great guide from Cornell Small Farms Program. It's an entire fact sheet on collecting sales tax. It describes what products are exempt from sales tax. So all fresh and processed foods, fruits, vegetables, baked goods, jellies, jams, meats, eggs, dairy products, syrup, honey, cider, etc. But then it also lists every single food product that needs to be taxed. Prepared foods for on-site consumption, candy, soft drinks, fruit drinks with less than 70% real juice. Cut flowers is another one where I see a lot of times we're not collecting sales tax when we should be. Trees like Christmas trees, hay, grain, and straw, if not being sold to another farmer. Horses for pleasure riding, crafts, topsoil, turf, gravel, ornamental crops. So, and then it also goes into how to get the certificate. I'm sorry about that. I'm going to include that link here. Basically, it goes down to like, what's the use of that product, right? Is that product being used to eat? Then you don't need to collect sales tax. Is that product being used for something else other than eating? Then yes, you do need to collect sales tax. Okay, next question. Hi there, we are applying for a COA to sell plants at market this spring. Do we need to list the market name as another location where we are selling? For like nursery plants, I'm guessing. Actually, Amy, I think you would know the answer to this better than me.
Remind me what a COA is. I'm thinking a certificate of insurance, COI, but I'm not familiar with the COA.
Yeah, Jason, if you could let us know a little bit more about what you're doing, we'll be able to answer that question a little bit better. Yeah. Next question regarding the responsible urban potted plants for gardens.
Okay.
Must like the nursery license, right?
Right. Yeah. So I think there's two things that you're asking about here. First, the nursery license, which is a thing that I'm assuming Katelyn is typing into her computer to find. And the second thing is certificate of insurance, which a lot of farmers markets require if you're selling your products through them. It's regardless of any product that you're selling, and some may require that you show your nursery license in order to sell those products at those other markets.
Yeah, I used to know a lot more about it, and then I went over to the world of livestock where we don't have to worry about those things. So I don't remember for sure. And if you have any questions about it, honestly, the best thing to do is just call Ag and Markets directly. I know it's a pain in the butt, and I know that it's really hard to sit on hold, but if you can call them directly, write down exactly who you talk to and get a real life answer from them, I think that's really helpful, because if I remember right, I do think it matters like how much you're selling
Mhm.
and what types of products and how those plants were grown. Like, are you starting them from scratch or purchasing and then reselling?
And
I'm really
what
sorry
media
that
they're in. Yeah, and if they're in media, yeah, that all changes what your answer is.
I'm writing it down now too. Okay, regarding the responsible person information, what's the effective date of assuming responsibility? Is this, I'm assuming that's in relation to the nursery license too. Typically, it's your start date is when you start operating as a farm, which is really loose, right? There's really no good date to do that. And that might be another thing that I would ask ag and markets directly, just to make sure. Nursery licenses are really tough because they really just depend on your farm specifically. So it's worth the call. I know it's a pain in the butt to do that, but it's worth the call.
And I promise they're like us. They just want to help you. Once you get a hold of them, which might take a couple of tries, but they're really nice people on the other end of the line, really helpful people.
Certificate for sales tax, if it's an herb, something that you're not going to that you're eating, you don't need to charge sales tax. If it's a decorative plant, so like a potted house plant, you do need to charge sales tax for that. All right. These are really good questions. Taxes are so hard, and I do apologize too, because a lot of the times, not a lot of times, some of the times the answer is it just depends, or you need to talk to your accountant. And the reason for that is that every single farm business is different. So even in how we depreciate out equipment, for example, each accountant is going to do that in a different way, and you need to pick one way and stay with it. So it is really helpful to get us accountant that you can trust and continue to work with. Can you use the ST-125 for online purchases? You absolutely can. And it is wonderful. 2023 is such a year to be alive. So if you're making chick purchases, buying seeds online, even Amazon, you can keep a copy of the ST-125 with that vendor, even if that vendor is outside of New York State. So great example, seeds, right? Chicks. I've been buying chicks. Amy's been buying chicks. We do not pay sales tax on our chick purchases. So you work with your vendor, you file your ST-125 with them. They keep that in your account and you don't have to pay sales tax on that. For Amazon, that's a little bit different. You have to like request a refund. It's a little bit of a pain in the butt, but it's usually worth it. And you just keep a copy of you give them a copy of your ST-125. Online purchases, in-person purchases, anything related to the farm, you can use the ST-125. If for some reason the vendor doesn't accept the ST-125, that's where you use the AU11 to get the refund. Amanda says you can set up the ST-125 on Amazon. That's right. And I think you have to do that under like the business account, right, Amanda? Because then it stores it in it separate from your personal account. It saves me a bunch of money, and I'm super grateful for it either way. For Jason, if you're just selling food plants, then you don't need to get the sales tax certificate, or you don't have to have a certificate to collect sales tax. The only time you need the certificate to collect sales tax is if you're selling products that aren't food or like that are on that list. So like candy counts and prepared food counts. But if you're, for the most part, most farm products that we're selling are not something that we need to collect sales tax on. All right. Any other questions? This is the most excited group I've ever seen about taxes. Thank you, Jason. Certificates of authority, COA. This makes a lot more sense because I've never heard it called COA, but now that I read that, I'm like, yes, I'm getting the missing link now. Thank you. Okay, so in regards to when you apply for your certificate of authority to collect sales tax, if you should list the different markets that you're planning to go to, but you can always add and adjust your application later on. And then as far as like the application date or the date to form your responsibility, in that case, it's when you start selling taxable goods. So if you have been operating a farm, but you haven't sold taxable goods, and now you're changing that, your start date will be now, rather than backdating to when you started your farm. Thank you, Jason, for helping us through that question. We were going to get you an answer. Amanda says, I think personal works too, but when you buy something for off farm, you have to turn off the exemption. Perfect.
Yeah, and with some stores, for instance, I'll walk into my favorite farm supply store that I will not name, and I'll make a purchase, like just say I'll buy a couple bales of wood shavings, then I'll buy some candy because I like candy in my truck. And so I run it as two separate purchases, and I say, this runs tax exempt, this one doesn't, and they're more than happy to do that. And another small note is that there are some stores where some purchases do not qualify as tax exempt. So not only whole organizations, but also individual purchases. Like for instance, there's a farm supply store that I frequent that does not allow you to buy clothing, even if it's used for the farm, like even if it's bibs, even if it's boots. So just keep that in mind as you're going on this adventure.
Yeah. And the other thing too is like, if it's like 25 cents that you're saving, like ask yourself, is it worth this time of filing like the AU11? But I think it depends a lot on the purchase size too. Jason, we've been notified differently regarding the collection of sales tax to sell a potted tomato or rosemary, for example. I call Ag and Markets and go with their answer, right? Amy and I are not Ag and Markets representatives. So call and then call again and then email and see which answers you get and go with the answer that you got most frequently. is the best answer. Next plot twist, are orange tractors sales tax exempt on Amazon? So one time I tried using we got like a toy orange tractor, which obviously costs a bunch of money. And I was like, I bet you I could get this sales tax exempt as like a farm purchase. I didn't, but I really should have, right? I've seen a lot of things getting written off as farm expenses that maybe shouldn't have, right? I've seen entire weddings be written off as a farm expense. The one farm that was my favorite had it under as an employee a recruitment cost because the daughter was marrying someone who was coming into the farm. So the entire wedding got written off as an employee recruitment. So it's all about like your comfort level with risk and your comfort level with getting audited, right? Okay, next question. Does your military retirement and spouse's income count towards the 2/3 gross income standard? That one, Hauser, I need to double check on because I am not sure either way. So it would be like, I don't know where that income ends up on your regular 1040, but it's based off of your adjusted gross income. So if your adjusted gross income, if that's where it ends up getting listed, they're going to look at what was the farm income over the adjusted gross income. But I'm going to look for some more resources for that specifically. Oh, can't believe that passed the IRS. Well, the thing is too, right? Like you have a 1% chance of getting audited, even though it's something that keeps me up at night. So there's a lot of people that claim stuff that probably shouldn't get claimed, but they might not ever get in trouble. And then the time that you do get in trouble, you might be really sad that you tried to write off a wedding. Jason, I'll call again. Thanks. We had a few interactions so far with Ag and Markets. Hard deal with, but just part farming. I agree, right? Like, I appreciate Ag and Markets. I appreciate everything they do. And I also understand too that they're underfunded and overworked. And so when I want an answer that I'm not comfortable with, I will call again on a different day and I will email. And that way I have 3 different responses. I have a written response in the form of an email so that then if I proceeded forward and got in trouble, I could go back to that. And with farms that I've worked with before, they've been okay with that too. So if they got their hand slapped later on and they could point back and say, I spoke with your office and was told this and responded accordingly, that's covered them in the future. And I know it's frustrating, but you're right. It's part of farming, right? Okay, Lou says military income is earned income, but not VA benefits. Thank you, Lou. Bailey, I don't know if you're still on, but this makes me think that maybe we could put together some more resources about how does the school tax credit work for veteran income as well. All right, I'm going to stay on for another minute because these are all really good questions, and I really appreciate you guys hanging in there on a Monday night, no less, talking about taxes.
You guys are fantastic.
So if you have any other questions, please feel free to drop those in. Like I mentioned, you'll all receive a copy of the recording and a copy of the slides with all of those links. And as you go through it, or if you have any questions that are specific to your farm that you didn't feel comfortable asking about in this space, feel free to email either of us and we'll help you out. Massachusetts doesn't tax military income. Interesting.
The more you know.
I think that's the other difficult part about the tax system, right? Is every single state does it differently.
Yep.
Every single tax preparer does it differently. So it's interesting. New York doesn't either. I'm gonna have to look into this now. So thank you guys for bringing this to my attention because I didn't think about that. So. All right. Looks like we're good to go for tonight. When you close out, you will automatically receive a copy of a survey. So please fill that out. Oliver is the proper grade.
I love that.
We've got a little antique tractor powwow here, and I'm really grateful for that. All right. Well, thank you, everybody. We're going to go ahead and end the webinar. Please feel free to reach out with any questions, and we hope to see you next week at our planning for Murphy's Law presentation. All right. Thanks, everybody. Take care.
Yeah.